XRP is currently facing a critical crossroads. The question is whether XRP can maintain its position at the $0.5 mark, or if the recent breakdown below multiple moving averages signals a more substantial retreat. And it's hard far. At a glance, the XRP chart displays a troubling picture for bulls. The asset has recently faltered below several key moving averages, which traditionally act as layers of support. The 50-day, 100-day, and 200-day moving averages have now turned into resistance levels which XRP would need to overcome to replane bullish momentum. These moving averages, particularly the 200-day, are closely watched by traders and can often dictate the medium to long-term trend direction. The current resistance levels are set near 0.5587 and 0.585, which represent recent local highs, and the proximity of the 50-day moving average. A successful break and close above these points could signal a potential reversal of the recent downtrend. Conversely, the support levels to watch are at $4,700 and $4,500, where buyers have historically shown interest. If XRP can consolidate and push back above the $0.5 threshold, it would need to sustain the upward movement and close above the aforementioned moving averages. This could instill confidence among traders, potentially igniting a rally toward higher resistance levels. The US dollar index serves as a barometer for the strength of the dollar against a basket of foreign currencies, and often has an inverse correlation with the cryptocurrency product market. Recently, technical analysts have been eyeing the formation of a golden cross on the DXY chart, a bullish signal where the 50-day moving average crosses above the second-day moving average. If this pattern comes to fruition, it could spell some trouble for the cryptocurrency market, traditionally sensitive to a strengthening dollar. And the DXY chart currently shows the index hovering around the 103.87 mark, with the 50-day moving average creeping toward the 200-day moving average. A golden cross formation would typically indicate that a long-term uptrend is on the horizon for the dollar, so it's suggesting increased buying momentum. Well, let's look at this place. Actually, the link between the DXY and cryptocurrencies is evident. A stronger dollar often leads to a decrease in the price of digital assets like Bitcoin and Ethereum. Investors typically flock to the security of the dollar in uncertain economic times, which can result in a pullback for risk-on assets like cryptocurrencies. If the golden cross in the DXY indeed materializes and triggers a dollar rally, the cryptocurrency market may see a corresponding downturn as capital flows out of digital assets and into the traditional refuge of fiat currency. And Cardano has recently exhibited signs of a trend reversal, stepping out of its bullish mode. This shift in momentum has prompted discussions among investors and traders as they reassess the asset's near-term prospects. After a period of sustained upward movement, ADA has broken below its rising channel, a structure that typically signifies bullish sentiment. This breakout to the downside indicates a potential shift to bearish momentum, or at least a pause in the uptrend. The price is now hovering around 57.5, just below the lower boundary of the former channel, suggesting just a possible new resistance. Looking at support levels, the immediate one is at 5385, which is critical for ADA to hold to prevent further declines. A break below this support could lead to a test of the next support level at around $0.512, where the 50-day moving average may offer some buoyancy to the price. And Cardano's current trajectory points to a cooling off period following its exit from the bullish channel. The volume profile shows a decrease during this downturn, potentially signaling a lack of conviction among sellers. However, for ADA to regain its bullish stance, it would need to re-enter the channel and sustain a push above the 60-cent mark, challenging recent highs around 68 cents.